And I'd like to introduce Simon Chadwick, who's the CEO of AVPN, to moderate this session today.
Thank you very much, everybody, for coming. We're almost at the end of the day. We're all going to get back together after the last break here. So thank you for coming to hear about fundraising. At several of the sessions, I've been hearing that the funding is the least valuable thing that is provided in venture capital. But again, without the money, there's very little you can do. And we have today a panelist of people who are intimately involved. They've successfully raised money. They're talking to investors. So I think we can cover a lot of ground from institutional fundraising to also fundraising from high net worth individuals. The way I'm planning to run the panel is to have a sort of a short initial session, maybe about 20 minutes, where I'll ask a question of each panelist. That will give them a chance to briefly introduce themselves. But everybody's bio is on the website, so you can look up and research some more about all the individuals. Then we very much want to go into a sort of Q&A session with the audience so that we address your concerns and what's important to you. So with that, I've got a couple of slides just to really frame the debate, and we can maybe come back to them if we need, because one of the key value adds of AVPN in a very abstract way is to facilitate fundraising, because we raise the awareness of all our members, their activities, and bring more people into the ecosystem. And AVPN is focusing very much on the top two levels of what we see as a three-tier ecosystem. So we're interacting with donors and funders at the top and trying to develop as effectively as we can this intermediary layer of venture philanthropy organizations. And the funding flows down, and primarily people are seeking social return on the upward trend, and impact investors, and one of the themes here, will combine that with some sort of financial return. And one of the key value adds as it passes through the intermediary layer is to add some human capital. And embedded within the venture philanthropy organizations is the intellectual capital they bring. How do they actually make this work? This is a slide that we use a lot. Fundraising is where you really come to the critical point, and often the most confusing point, as to what is impact investing and what is venture philanthropy. And when you ask for money, you do have to be very clear what your proposition is and whether or not you are going to give some sort of financial return. And at the bottom, on the third layer, people can choose between investing in regular businesses, in social enterprises of various shapes or forms, and also directly in non-profits in the form of grants. And venture philanthropy is a methodology, a way of deploying that capital, can be applied across all of those. Now I'll turn to the panelists and ask them one by one to introduce themselves, starting with Diane, and also posing a question for you from your background is, how do high net worth individual diaspora donors approach philanthropy?
Hello, my name's Diane Yuran. I spent 16 years doing fundraising and as a philanthropic advisor in the nonprofit sector. The last 5 years were spent at Gift to Asia. Gift to Asia was based in San Francisco. In the past 5 years, I raised about $120 million, and all that money was actually directed to projects here in Asia. So recently I started a firm called Coordinate Philanthropy Advisors, working with donors and clients, philanthropists, trying to leverage their capital to do more. So in answering that question, there's 3 points I like to make. And the first is that I think diaspora donors like to be very involved with their philanthropic activities. And their personal involvement comes through, research, site visits. They like to talk to their friends, their families. They want to ask questions about issues. And there's this inner circle that they have and that they trust to go to. The second one is that I wanted to talk about a little bit of the impact that they want immediate impact. It's very tangible. They want to know who is benefiting and how the money is being used. The transparency is really important to them. But the impulse is to do something very specific, specific groups, specific organizations, specific region, area. I mean, we just keep going down to specificity. And then the third one that we're seeing is that one way they're looking at giving back is to create economic opportunities from where they're from. And this can be seen as these commercial investments. And I think from there, there's a ray of hope for venture philanthropy and impact investing. So my 3 main points.
Thank you very much, Deanne. Maybe turning now to Eric. Eric is the co-founder of Unitas Capital. And sort of one of the important questions in this area is to find out, are people really making money from social investing? And does that give us some optimism for the future?
Of course, never enough, thanks, Simon. Just briefly in terms of background, I co-founded and run a company called Unitas Capital. We're a Bangalore-based social investment bank, which is quite an oxymoron, but we basically focus on helping socially impactful companies raise capital. And the basic premise of our organization is that there's lots of fantastic companies out there that make a very strong social impact, many of which are also very financially attractive. Naturally, there should be a lot of investors looking for attractive financial investments, but for a variety of reasons, the two have a hard time finding each other. So we work across a variety of sectors, across education, healthcare, microfinance, renewable energy, agriculture, affordable housing, primarily those 6 sectors, helping companies raise private placements of equity and debt. We have a team of about 20 people in Bangalore. We have a very significant focus on India, but we also work across the Philippines, Indonesia, and China. And we're really gearing up in Indonesia at the moment. We've raised about $800 million in the last 5 years since we set up the company, and have gotten to work with a number of amazing companies and investors. I think to answer Simon's question in terms of whether investors are making money, frankly, in some ways it's early days, and that many investors say that someone like Loke, many of them have come in the market in the last 5, 6, 7, 8 years, and so they're getting to the stage now where they're starting to have exits. We've seen now 2 years ago, I couldn't give you any data. In the last year and a half, we've helped facilitate 8 separate exits from investors in socially impactful businesses. Of course, that's still a very small sample size, and it's not representative, because obviously places where people have exited are more likely to be some of the successful investments. But in those 8 investments, I think the average return has been about 3.8x, and the average and median being very close together, and the median IRR would be, I think, around 37% or something like that. So very strong. Again, that shouldn't be indicative of an average of all investments, but I think you see a lot of people doing well. We actually have another transaction that's closing next week where, you know, some of the founding shareholders are exiting, and they're getting a 70x investment on that. But that's on someone who's put very small capital into a business that's still, frankly, very small but growing. So I think it's encouraging that you do finally now see people making exits, and so that will allow people like Loke and others to raise their next fund, which is what the sector really needs.
So Eric gets to see both sides of the fundraising, and as he said now, facilitating some exits and seeing the exits so that people are building up track records, which is key to go on to the next round of fundraising and also scale the whole size of what's happening. Mikolos, from your perspective, you're very much involved on the philanthropic side and interacting and researching the ultra-high net worth family community. Will we see philanthropic leadership from families here in Asia, and how are people reacting here to the Giving Pledge?
So first, good to be here. Good to see a lot of familiar faces in the audience. So thanks again for having me in. We already are, but I'll tell you more about that in a second. Very briefly, in my background, I used to run the Wealth Intelligence Unit at Forbes, so familiar with the billionaires list or the Hong Kong or the Singapore rich lists. That was our beat. And now run a company called WealthX. Relative to the Giving Pledge, we very much believe that our data shows we're at the beginning of a 150-year wealth creation cycle in Asia. So yes, there are some individuals who've signed up to the Giving Pledge, that major program where individuals are pledging a large portion of their assets over time. But the bigger story, I think, is the transition of wealth. By the way, we can switch slides. That would be great. There are, on the ultra high net worth space, right, and you've got to look at the world's money in terms of the mass affluent, the high net worth, and the ultra high net worth. The transition of the most to the highest density of high net worth people, 1 million to 30 million of net worth, has happened and has come east, right? What hasn't happened yet is a transition of ultra wealthy individuals, those numbers in the east outnumbering those in the west. We think that'll happen in the next 15 years or so, and that's when we'll see a lot of the even larger gifts take place. So giving pledge style, which is large amounts of money. If you look at sort of where that came from in the US, chiefly, it was driven off the back of the Industrial Revolution, and that's why you have the names like Carnegie taking leadership, great stories out there. I highly advise one of his own personal writings called The Gospel of Wealth, if you haven't already read that, to read about his transition, his evolution, if you will, into why he chose to give such large amounts of money late in his life. I think we'll start to see a lot more of that as the tycoons in Asia get to a place where they've basically conquered every mountain and now looking at how to effectively take on another new challenge. But we're very early. We're probably 15 years into that evolution, so we believe there'll be much larger gifts happening in Asia over the next several years.
Thank you. Vishal, maybe you've been active for longer than most people, and perhaps given the subjectivity around defining social impact, how best do you ensure alignment when you're with prospective investors and fundraising? Because that's where the trade-off comes between where is financial return and what social impact are you going to create?
Just a quick background. Lok Capital is a India-focused fund. We are in our second fund right now. Fund 1 was exclusively microfinance in India, $22 million. Fund 2 is $65 million, looking at financial inclusion, healthcare, and education. We are primarily funded by multilaterals, IFC, CDC, FMO, KfW, Proparco, are the 5 large DFIs that are supporting us. Over the last 7-8 years, we've done about 14-15 investments, had 4 exits, returned 60-70% of the first fund back. That's the current, that's the brief background. In terms of your specific question, Simon, I guess, the confusion about impact is naturally quite large. If you could please go back to that one slide that you have, the impact first, and remember these. Yeah, I mean, this by itself, impact first, impact only, you get to see the various shades in terms of the way people look at impact. Now, within this also, what is impact? That itself adds another layer of complexity. Again, just to give you a sense, is it only reaching the, what we call the BOP, or is it impact more in terms of what each sector requires? For example, as we are looking into healthcare and education, we believe each sector would have its own impact criteria based on where that sector is actually has evolved to in that particular context, right? Education in India is a very different level where healthcare in India is. So you just can't look at impact from a common lens and say this is the way, impact will be driven all across. So there's enough complexity and there's enough gray, and I think that will always be there. The real, I think the central point that becomes is, how do you first identify and clarify to yourself what really is the impact that you're going after? And then how do you articulate and make sure that your LPs fully and 100% understand this, right? Because I think otherwise that's where a lot of confusions happen. And seeing is believing. What we do a lot is make sure there's a lot of P-LP connection. Ps are promoters and portfolio companies. LPs are our LPs. So we make sure that they are regularly meeting each other. They're not just seeing, LPs are not just seeing the impact and our portfolio companies through our reporting. They're actually going and meeting there. We do a lot of co-investments, which I think has proven a wonderful way of, again, making that bridge, making that expedition match, remove that mismatch. Fund 2, almost 50-60% of our investments have been with co-investments with our LPs. That's been a very helpful tool so far.
And in terms of the chart that we have at the moment, where are you investing? Are you in really the orange part, picking sort of strong businesses that are operating finance first, but then can demonstrate to you or meet your social impact? Or are you in this sort of social enterprise, sort of darker orangey area in the middle?
Yeah, I'll have to digest this to say where. But basically, for us, impact and finance both have to be there. It's not one versus the other. We have, for each sector, as I said, a very clear impact criteria now. The finance criteria, seems to be uniform all across sectors, but both of them have to be there equally for it to make sense.
And are your investors getting more rigorous in terms of the questions they're asking? Are they getting more demanding about the impact side?
Yeah, I think when we started, at that time, neither the investors, to be honest, nor us had a very clear sense of both sides. How much real impact and what returns we can actually give them. The good thing is, at least the investors that we deal with are multilaterals. They are more than happy to be guided by our experiences. So once you build a relationship, I think they are happy to rely on you to say, this is what I'm finding on the ground, therefore this is the way we should define it. But clearly, the expectations are getting much more evolved. And they want you to define it much tightly compared to what it was 7 or 8 years, which is nothing but a sign of evolution as a sector.
And if at any point any of the panelists want to comment on anything they've heard from the other ones, please do leap forward and grab the microphone. I was actually going to come back to you, Dien, to say we've been hearing about the financial return side, or more on the impact investing side. When you talk to philanthropists, do you find them wanting to allocate a lot more capital or time to impact investing, or generating both a financial and social return, or are they more interested still in what would be traditional philanthropy? And from a venture philanthropy perspective, that's approaching it in a business-like way, looking to be effective, having measurable results, but then no financial return.
I think for now, it's still 100% philanthropy or charity. Here's the financial support. But they are definitely asking questions about what is impact investing, what is this here thing that I'm hearing all the time. So there's still a lot of education that needs to be done. And of course, a lot of the donors or philanthropists I'm working with are Asian Americans, and they're mostly first generation immigrants. So they're the ones that grew up, that were born in Asia and then grew up in the US and now have ties back to Asia, whether it's business or family. But they're definitely catching wind of this, and they're very curious.
Miklos, what trends do you see as you research the ultra high net worth community as to their appetite for innovative philanthropy or strategic philanthropy, which are other words for venture philanthropy, or is there a move to be a much broader social awareness or seeking social impact from what they do?
So I should probably give just a little bit of context on what we do at WealthX, where we're coming from. We have the world's largest research organization that identifies and profiles very wealthy individuals, those with a net worth of $30 million US and above. We don't do investigations, we don't call people or phone hacking. It's all based on publicly available information, right? That said, we do track gifts. We look and see where the money's going. And similarly, I don't think we've seen yet a substantial focus yet on venture philanthropy. I think that's still to be developed. A lot of it still is around charity, around the straight gifts. We haven't seen any substantial evolution there just yet.
Maybe I'll turn back to Eric, and we'll focus on the topic of fundraising. Why is fundraising often even harder for social businesses than normal businesses?
I think that I think it often is. I think there's two sides to it. One, if you have a social business, there's the positive side that it opens up an investor like Lok and other impact investors, and so you have a different group of investors that's available to you. So that's on the positive side. But on the negative side, if you go out and claim to be a social business, then an investor naturally is going to ask you to prove that to them. And so you have that. There's two parts to it. I'd say one, there's the burden of proof, saying, okay, if you're saying you're going to go out and prevent all these babies from being malnourished, give me some data, prove that to me. And the second side is if it's a more mainstream investor, they're gonna say to you, okay, they may say, I'm a little uncomfortable. It's a great thing that you're, helping these malnourished children, but I'm just looking to make some money. So while that's great, I'm concerned that even though your projections are showing that the company will make a lot of money, do you really want to make money, or are you just trying to save the world? And so I think there's some skepticism around people who are saying that we're going to have both a strong financial return and a strong social return, which, again, we've seen many companies do that, so I have absolutely no doubt that that's possible, but there are many people who still have that question.
May I just add on to the question, right? So I had the misfortune of fundraising back in 2001 after the dot-com bubble, and remember walking around on knocking on 84 doors and getting one investor in a for-profit business to say yes, right? I think fundraising is extremely hard either way. And one of the opportunities, I think, with social investing is the ability, just like in any other fundraising activity, to latch onto the hearts and minds, dreams and fears of the investors. So in either scenario, I think it's very important to figure out the right person to be talking to about the investment. That's sort of the key thing that I found that ultimately works, and that everyone says they invest for financial reasons. I think they're mostly lying, right? I think the reality is they're investing for emotional reasons. Yes, there's qualifications and check boxes they've got to go through, but the ultimate decision is an emotional one. And whether that's venture philanthropy or whether that's a purely commercial enterprise, either way, that particular learning works.
I'm happy to open up to the audience if you've got any questions or share your experience, please.
Norway, we were working earlier this time in Burma. Interesting, since we're all here from so many nationalities, if anybody would care to comment on the various type of approaches, emotional or rational. Burma, clearly there is a concern about the next life and buying merits. Probably be different in Indonesia, probably be different again in Thailand. I wonder if anybody would have any comment on that.
The importance of emotional drivers, and particularly in the context of Burma. Religious drivers. Diane, from your experience, is there a sort of overt religious driver, or is that often somewhere behind the scenes or private motivation?
If it's religious, it's definitely philanthropy, it's charity, right? And I think there's some religions that forbid the return of investment. I think we all know that. And in the case of Burma, I've had the fortunate opportunity to work with a couple of Chinese families that actually lived in Burma and left and went to the U.S. And they are definitely giving back to Burma. But they're also very hesitant. They're very, and this is, I've always wondered this question, whether they're very hands-on because they don't trust what's going on. And they're always overseeing the organizations and asking some, they're deep diving into the questions, right? So is that because of a trust and transparent issue, or is it because this is their joy, this is what they want to do, they really want to build up the organization? So I'm still trying to, I wonder about those questions, and I'm kind of hesitating to ask, but I should probably ask one day.
Eric, do you have a...
Yeah, I think a lot of it is based on people's personal experiences, and so if you grow up in like India, where I live now, and you become wealthy, you would have at many points throughout your day, every day, you'll see a lot of people living in very difficult situations, and so it would be almost unnatural if you didn't want to do something to help a significant number of people around you if you had the means to do so. But I think even people who grew up in the West and whatnot, it's often a personal experience that will spark something. So the gentleman, Mike Murray, who founded Unitas Labs, which is a company that incubated us, he had a chance meeting with Muhammad Yunus 15 years ago. And that changed the course of his life, and he's gone on to, he started Unitas Labs, and they've incubated a number of organizations. And so I think it's often a personal experience, or it could be through certainly a religious organization. You're excited about your church and your religion or your temple, and then they say, okay, we're going to go do this project, and you get involved, your friends are involved, and so I think it's often a very individual experience.
Anybody, any other comments from the audience, contribution or question?
It's a question to probably to Nicholas regarding the perception of impact investing here in Southeast Asia amongst the high-net-worth community. It was said several times today that the subject of the call was relatively recent in Asia and Southeast Asia. So what is the perception, and do you think that's something that's beginning to grow?
So the question is, what is the perception here of impact investing at the moment, and is it something that's really going to grow in the future?
So, unfortunately, I think the perception is there isn't much of one just yet. Looking across the markets and the options that are available to individuals to invest in general, those are somewhat limited for the high net worth and ultra high net worth communities. So take mainland China, for example, or let's take Indonesia, we're talking Southeast Asia, where the investment options as a whole, right, haven't been that voluminous. So there's just not as large a menu to choose from. So I think there's both a challenge and opportunity in building awareness about social investing throughout the region. I'd say throughout, frankly, all of Asia, but especially so in parts where there are large pockets of wealth creation, like in Indonesia, like India, like Singapore and Hong Kong, which are great funnels, if you will, for very wealthy individuals. But if you look at most of the content that a lot of individuals are consuming, there's very little dialogue about social investing, if any, frankly. So the good news is it's a blank slate in many ways, and there's an opportunity to craft the story. But I think that's one of the challenges is how does this collection of individuals in the ecosystem get together to take the message out there about what is social investing and how it can be extremely helpful to a region which can certainly benefit from it, as can every region, right? But I think it's very early stage right now. It's really not on the radar, frankly.
Yes, follow-up question? I'm not sure everybody could hear you. I think these are good points. Would you mind going to the microphone and then we'll... Sorry, it's just part way up the stairs, the nearest one. Or you can come to the podium if you want.
Okay. I work as a CSR manager in a law firm in Beijing for about 8 years, and the government sent somebody to have a look at me because they were saying, what are you doing? All your clients are NGOs and corporate foundations. And we had a client called the Salvation Army. And of course the government went, there's a bit of a problem with that, like Salvation and Army. So we realized we had a bit of a branding issue with some of our clients. So the government guy came to sit in my office. He worked out that actually our purposes were aligned, which was poverty alleviation. It's just our means were diverse. So he said, can you write the English side of our Chinese government philanthropy magazine? So I've had to learn sort of from him how to do that, and I'm still learning. So I'm very interested to learn from the US, from somebody who's been in Forbes, how we utilize Chinese media to incentivize the entrepreneurs to climb the next mountain. It is different here because they don't want to be hit by the taxman, as you know. So sometimes they want to be very covert. They've actually renamed me they call me the repentance department, or the flowers after the affair department, because I'm telling you, that's where we get our big hits in the philanthropy sector. But I'm sure it's no difference in the States. But I'd just be very interested at how you've utilized media as a tool to get the Cheng Guang Baos. I mean, we don't need to motivate him, but some of the quiet givers, how do we give them some comeback in the media?
Sure, it's a great question, and certainly a great challenge. You know, I can share that when we were at Forbes and we published the China Rich List, that was always, unfortunately, the jail list, because a large number of the individuals ended up, in prison or having other challenges soon thereafter. So there's definitely a concern about raising one's profile too quickly or too visibly in terms of giving back. You know, the interesting thing is a lot of these individuals are giving back already at early stages in their career or in their evolution in smaller ways, right, to their local communities, to schools, certainly. Education is one of the biggest places where they're giving back. So I think there's an education to be done and a sharing around other causes outside of education earlier in their wealth creation cycle, frankly, to get that process started, right? So just simply getting education, getting it out there. I also think as we look at Asian entrepreneurs, there's some differences between what happens in Asia or Europe or US. We find that they will work typically, and this is, I hate to typify Asia as a broad collection, but if I can draw some conclusions, that the individuals will work much later into their life, and as a result, they'll have sort of less of the golden years, so to speak, in terms of their other activities, right? They're still at the office a lot of times at 60 or even 70 years old. We see this in Indonesia a lot right now. So it's very late in their career when they're thinking about giving back in large sums. And our focus at WealthX is around the major gifts. If anything, I think we'll see an evolution as we have, let's take example for Russians, in that there's a question and a desire to learn, what should I be doing? There's actually that question being posed behind closed doors of, great, I've got lots of money. I've got my 4 houses, I've got my Lamborghini, or I've got my various toys. But what's next, right? Part of it's education, getting the kids, for example, into the right institutions, making sure they're in the right MBA programs, but then what is the next thing? And I think media in general can do a huge role of education in sharing this other part, this big area called philanthropy, with these individuals. Now the challenge becomes, where does social philanthropy fit into that? I think that still remains to be seen, but the media can do a lot in getting out this story around philanthropy. I mean, I go to a newsstand in Hong Kong or here, and every other magazine is a luxury lifestyle, and there's nothing really about philanthropy, right? And that's unfortunate. And part of that's because of individuals who want to be shy, but also because the media is just not reporting on it. It's not as sexy, perhaps not as interesting as talking about who spent what or who has what yacht. My hope is that we can encourage the media to do more of that, get those stories out there, because inevitably, and we see this across geographies, it's friends of friends who also encourage activity. So again, I'll go back to Carnegie, sort of the first example of this, but it was he and associated tycoons that really started giving in major ways at the time. And we see that in the US, we see that in Europe, we see that between families who are looking to solve great challenges. We see it in the Giving Pledge as well. And so I think there's a lot that can be done to encourage these groups of individuals to give back in major ways. What should the media be doing? We should all be encouraging the media to spend a little less time writing about the latest car or the latest yacht or the latest house that's going to sell for $60 million in Beijing, and focus on giving back in some of those good stories.
I think one of the things we're seeing in China as well from the AVPM perspective is a rapid institutionalization of some of the philanthropy, because the very wealthy, successful businessmen have several levers they can pull. They can have a private foundation, and there's been a huge growth in private foundations. I think the issue there is the money's not being deployed very much. But that you can solve in a more institutional context, because they've managed to separate it from their individual self. They also have a company, and the corporate CSR programs are getting more active, and you can do things in social investing from your company balance sheet and mobilize your staff in a way that adds a lot of value to that too. So I think we'll see more of them, if you like, not directly, but indirectly, very powerfully contributing.
Just to add to that, I'd say some of your donors are also, they like to be anonymous, right? So even if a reporter calls me and asks me, can I talk to this individual, I would call my client, they say, no, I'm not talking to a reporter. So sometimes it's not the reporter's fault for not writing a philanthropy story. It's sometimes donors they don't want to talk to reporters. They don't want to get the word out. They want to be anonymous. And there's also this humbleness that comes along with it. On the flip side, you also have some donors that say, where do I show up, and where's the ribbon cutting ceremony, right? So there's a balance, and sometimes the reporter's like, okay, I'm the same guy again. So I think we just have to do a lot of education to our donors and say, sometimes being an example is a good thing, right?
It's actually quite a contrast, especially in India. We sometimes have felt that the social enterprise space has been getting a bit more attention than what it really deserves in terms of the actual size of the thing. So it was just and there I think the other risk, what we also need to keep in mind, is if the media themselves hasn't evolved in their thinking as to what venture philanthropy is, there are going to be instances where the negative press will also spread out, and that will really discourage. And we've gone through that phase in India at least once in microfinance. That would really encourage a lot of the aspirers who were just on the. In fact, we were in our second fundraise that time, and some of those private families that we were talking to, they just vanished, just because there was so much of this negative press also. So I think media education, building that, we can't assume that media will be, fully informed, and for that matter, even the government and the politics also.
And I think overall there is a lack of consistent data gathering. It's early in the track record stage, but more people need to contribute, if you like, more deals, so we can establish some fact points, because a lot of the research is from the top down, and it starts with the billions that potentially should be there. But actually the number of deals happening are quite few, but looking very promising as this grows over time. One question in the middle, so if you speak loudly or come to the microphone.
Thanks. Question probably for Eric and Charles. Just I'm really interested in your investor profile, so that with every issue you're finding that this is kind of a catalytic philanthropic event for them, and if so, is it supplementing or complementing the historical fund? Or is this sort of a means of potentially having a catalytic effect on other people?
Okay. When you talk to your investors, does this have a catalytic effect on their philanthropy, having invested in you? Was that the key question?
Yeah, two problems, I guess. The first is, are the majority of your investors existing philanthropists? And if so, is there interest in a particular fund that you're pitching, underlying with a giving? And if they're not philanthropists, have you seen through their investment extent giving through another impact investment or even the traditional philanthropy?
I'll answer it in two ways. We have individual investors in our own company. We're a for-profit company, and so those are ultra-high net worth individuals from Europe and the States, and I think that they're already very philanthropic, minded, or else frankly they probably never would have invested in us as a startup company. And that investment, I think in many ways they're very happy, and that their investment has been leveraged, I don't know, probably more than 150 times in terms of how much capital we've then raised for socially impactful businesses. But the money that we raise for socially impactful businesses, it's 98+% institutional investors. So a lot of it is impact investors like Loke, and there's dozens of other impact investment funds out there. And then we work a lot with mainstream venture capital and private equity funds that are looking only at commercial returns, and we work some with the development financial institutions. And so frankly, those companies are all investing according to their mission. That mission could either be to have impact and financial return, it could be purely financial return, etc. So I think that the capital that we raise for the company is often catalytic because they leverage it and raise more capital later, but it doesn't change the investor focus at all, and the investors already are investing according to their guidelines.
The only thing I'll add is, we deal with also 95% DFIs, as Eric mentioned, the IFCs of the world and all. Some of our LPs of the similar nature do want to put conditions that our investment should then further help you raise more private capital. I don't think we've been very successful at that as a sector. There is still, if you look at predominantly in this space, especially in the not just the impact only, but the impact first and the financial first, that kind of spectrum that Simon had put there, more and more DFI type capital, just in terms of size, that a fund at a sector level that will be much bigger than the private capital.
I think there's far more focus in impact investing in trying to attract people from traditional investing and still promising, if you like, a competitive risk return, but also with the value of a social outcome as well. And we talk to people on the philanthropic side, either institutions or individuals, and they have much more of a problem trying to bridge between the two and then deciding if there should be a trade-off in the middle. and more money is flowing into those who say you don't have to do a trade-off. Our proposition is you can have both, I think. And that's where more of the money is flowing from at the moment. One more question? Yeah?
One question to Eric. Could you talk a little bit about the dynamic when there's potentially a syndicate between a traditional venture capital fund and a social investment fund that investing together? What happens between the league there? Is that fairly common?
I think it is. The question is they're often impact investors and purely commercial investors coming together, investing in the same company, and how does that dynamic work? That is becoming increasingly common as a number of these great social businesses scale up. And then as a result of that, when you do larger and larger fundraisings, you often outgrow the social investors in terms of amount of capital they can raise. As an example, we work a lot with one of Lok's investee companies, a microfinance institution called Jana Lakshmi. They're Bangalore-based. When we started working with them 4 years ago, Lok was already an investor, along with 2 other social investors. At that time, the company had a loan portfolio of around $5 million US. Today, it's around $200 million US. So they've grown spectacularly, despite the microfinance crisis in India and the global financial crisis, et cetera. And so initially they had only social investors. When we went and raised a new round of capital for them 2 years ago, it was done in 2 stages, but 2 investors came in. One was CVC, City Venture Capital, so a mainstream private equity fund. And this round in total was a little less than, it was about $25–30 million. And then Gawa, a Spanish-based social investment fund, also invested into that round. The company's now doing a much larger round and looking primarily at mainstream private equity investors. So you have, that company now has a real mix of investors. They have a few private individuals. They have 4 social investment funds, and they have 1 very large private equity fund. They have a hedge fund as well. They have a Hong Kong-based hedge fund as an investor in the company as well. And so I think they all coexist relatively well because they're looking for the same things. While the hedge fund and the private equity company aren't as focused on the social mission, they understand that that's a core part of the business. They're very comfortable investing in the company with that as their core mission. And so I don't think it leads to too many boardroom squabbles. And so it's really a lot about the individuals at those institutions and that they can coexist. There is concern from the mainstream investor's perspective. If there's a social investor in there, can we get along? But I think that for the more commercially minded social investors, there's an easy ability to coexist with mainstream venture capital and private equity funds.
One point I will add there, apart from, it's really the people, right? I mean, we've had good experience in the company that he mentioned, but we've had some terrible experiences in where we got a pure play commercial fund and we just couldn't sit at the same table. It was very difficult. And I think in our experience, the secret sauce is the promoter. The promoter needs to have complete control of the various stakeholders. If you let the shareholders drive it, so there has to be that leadership absolutely out there. Because there is confusion, there is gray, and you just can't take that away. But are you then addressing that proactively and making sure that people do understand each other's? But I think the main formula also is, this is less to do with fund philosophy, this is more to do with individuals who are across the table and all that. Right? So.
Yep, thank you, please. That's a good question. How can we incorporate failures into the fundraising loop?
Exciting learnings.
I think also it depends who your target funders are, because often the failures can get forgotten very easily if you haven't formalized your program and your approach. And this is where it's often not as transparent with individual donors and individuals as it is if you approach institutions, where you will have to give a full and open report on your mistakes. Eric?
Yeah, I was going to say, at least in the institutional fund business, the traditional venture capital private equity business, failure is sadly very commonplace. And so every fund that ever undoubtedly would have had businesses that have failed. And so obviously to be a successful fund, you need to have more successes, or at least bigger successes, than your failures in aggregate. But it's very typical that actually you'd have lots of failures, and hopefully you have a few stars that make that work out. So I think from the institutional investor, it's well accepted, but you do need to have those great successes to counterbalance them if you want to have a next fund and continue to grow.
I would say individuals are very forgiving. And it's sometimes the individual knows about the organization that they're supporting so much more. And they really, the passion, the emotional ties, I think they understand if you explain to them why something failed. And in the 2 times I've seen it, instead of stepping back, they actually dumped more money in. So it worked. For these 2 opportunities, it did work. But there were lessons learned, and then they were able to bring in some management consultants to help them move along. So I think it's about transparency. You've got to talk to your donors.
I think one of the other issues that came up with failures are there maybe aren't enough failures because of the accountability, the reporting, people trying to measure effectiveness, and it's very difficult to stop funding. And particularly if you have an emotional involvement in that. And that's one of the most difficult things, is if you want to be backing some winners, because not everybody will be a winner, and if the resources are scarce, then you will have to make a choice. And that's the same in regular philanthropy and grant making, as well as in some return seeking as well as social investment. Any more questions? Could you speak up, Sonia? Sorry.
Just to add to that question, you mentioned at the beginning that social capital is an important part of what investors bring, and I wondered if the panel could talk a little bit more about how investors bring their expertise and their experience to the projects that they're investing in.
Okay, who would like to start with that one, bringing their social capital or their expertise alongside the financial capital that comes?
So by social capital, you mean anything else which is non-finance? Sure. Sure. I think the 2-3 areas that over a period of time that we've been able to probably be most successful at in what is typically mentioned as value add is clearly in terms of human resources. In our first fund, we were able to recruit or help recruit CEOs in 50% of our companies. Or just the next level, right? If there was already a CEO. The other area lately that we've been very successful is, as I said, co-investments, right? So in terms of helping the company that we already invested in to bring in more capital as they grow, etc. The third, and especially more impact-oriented, is given our own experiences of looking at impact now across sectors, across companies, to make some of these companies also realize and capture systematically their impact. We end up doing we actually have a standard term in our term sheet now. Within 3 months of investments, we'll do what we call social action planning, which is nothing but a 2-3 week of an operational review of the company in terms of looking at how do you tie the impact and your core operational processes, so that these things are not looked at separately. Here's the business side and here's the social side and all that. How do you try and integrate that? And we think the best way to do that is if your core business systems and processes by themselves become more and more aligned to your social objectives. So that in many of our companies has been a very refreshing experience, because they themselves on their own haven't had that kind of an exposure.
Any other comments on that? I think I was going to ask Diane, because earlier you said people do want to get involved often when they make the commitment. Do they then bring their social networks or their business skills or mobilize other people in their network towards those organizations as well?
Yes, they do all that. But a great example is there's in Cambodia, this donor has been supporting this group for 3 or 4 years now. And when the property went up in Cambodia, the rent went up. So they wanted to buy the building that they were in. And this donor is a real estate investor. And he didn't know much about Cambodian real estate, but he was able to find somebody that did. And they were able to renegotiate with the bank a certain amount. And this donor had to put up 25%. To buy the building, and he didn't want to make it as a philanthropic gift, so we structured it as a loan. But as part of that deal, he asked the organization to raise a part of the money because he wanted to make sure there was an endowment there. But the organization wasn't able to do that. So he said, okay, you know what, you raise this money, I'll give you 50%, and I'll match it dollar for dollar if you raised it. And in addition, I'll throw you any house party you want, you have my Rolodex, go raise the money. And they did. And it just talks about how involved the donor was and how much they trusted this organization. But it also was a real test for the organization if they were able to step up. So, hope that helps.
Thank you. I was just wondering if there's anybody here in the audience today who's actually out there on the fundraising path and is facing particular questions from people. Particularly around any trade-off that they think they're making between generating or accounting for a social return and a financial return.
My name is Shoshana. I run a project in Afghanistan called Toolkits Fundraising. And we're at a stage now where we've sold about $2.5 million worth of traditional crafts, high-value luxury ethical goods, jewelry, tour, and spun off, let's say, 10 Afghan businesses run by men. And I'm now beginning to try to raise money for them. Also raising money for the NGO, but I think they could probably take $250,000 between them. Now the question is, they go to an Afghan bank, they're being presented with 18% request of industry. Even talking to people here, I'm trying to figure out whether, I mean, I'm willing for people to give really, really soft loans. What's difficult for me is where to pitch, actually, because what they could use most, and listening to your idea of the revolving capital would be amazing. I'd love any advice that people have on what's the best way to approach this, because I could ask them, and they could probably do it for a 5% return. But do I really want to pitch there, where I then take 5% out of their business, or do I want to say, just give me $250,000, I will give them a student loan, and actually, would you be willing for me not to give it back, and then get it back ourselves and put it back in? Because I can do any of those things. I think one's better. What's most interesting to this sort of field is this?
That's a very interesting, very specific situation. Has anybody got any comments on the audience? Tried to do something similar? And this is happening in Afghanistan at the moment.
Yeah, so I'll comment. Right? You guys want an opinion about this? So, of the entire, sort of ultra wealthy population, right? That these 200,000 people represent $26 trillion of net worth, right? 12% of the world's wealth is in these 200,000 people's hands. If you think about what they've got in terms of liquid assets, at least sort of a little less than half, in fact, of that is liquid, so cash, right, that they've got. So we look at it and say, geez, there's a huge amount of capital that's not deployed. Now, for some reason, that's going to be in cash, and that's fine. But there's an extraordinary amount of money that has yet to be put to work. And it's a matter of matching up individuals who have the emotional reason to put that kind of money together. But between that community and $250,000, I've got to imagine that there's a easy, ready connection. It's just a matter of finding that right person or persons who'll put that kind of money to work. And that's usually, I think, what's missing, the break, is there's no efficient way to find the person who's going to write a $250,000 check because they have some connection of one way or the other to the organization, to you, to Afghanistan, or something else perhaps regarding the trade or luxury. Right? There's someone there. It's just a matter of finding them. So that's our view is you can go through all the other, and to your point, 5%, 2% loans, but as long as you find the right person, raising the money is easy. It's finding the right person that's the challenge.
Eric, did you have a view on how you should pitch this, whether you should say, no, make it commercial, or you should ask for something that's...
No, I think actually Nicholas is right in that the answer will be different depending on that person or the organization as to what they look for in terms of their returns. Frankly, the vast majority of what we do is at very commercial rates. And so if local market rates in Afghanistan are 18%, that's the level we would do. And frankly, that's where the larger volumes of money often are, unless you happen to have access to some of these people with the $26 trillion, half of which is cash sitting around. But the institutional investors who are incentivized and out there investing all the time, most of them do things at quite commercial rates. Of course, you could approach the development financial institutions of the world and whatnot, some of which do have some serious pools of subsidized funding. Unfortunately, there's a long lead time in working with them, and so that's a lot of time for a relatively modest amount of money.
Go ahead.
I love Turquoise Mountain. I'm going to make a pitch for you. I think it's a great organization. Just because I know your organization, I would say, you know what, pitch it to the donors. Say it's a capacity building grant, say it's a program related investment, say whatever it is, take the money and then turn around and loan it to the groups. Because Turquoise Mountain's got a great reputation, great brand. It's very well known. So.
I was going to comment briefly on that because what you can do here is you can split the layers and you can split the promise between the different layers. So you're talking to companies that are needing to borrow money at the bottom. You can put together a collective vehicle or say there's a lot of risk involved in here. We want to do something to maybe disrupt the market. If you say they could just go and borrow from those banks and that's all you're trying to solve, that's not very attractive. But if you say they're not really prepared to lend to these organizations, they don't understand them, we need to create more lending, then someone may come in and say, look, I'll give you a donation, I'll let you recycle this money in the middle, and I'm happy if you say that they should borrow at 5% and you think you'll get the money back. But then something is going to change in the system whereby a lot more money comes in because they see these success stories. And that's one way of not having people to really evaluate what return is right, because they want to see some other wider change from this. We've just got a few minutes left, so I'm happy to take any more questions or comments, maybe 2 or 3 more. Any more questions? Well, we're coming up to another break, I think. This is a longer break, and then we all get back together for what will be an interesting last session. So thank you very much for your attention, and see you at the next session. Thank you.